Hey, good afternoon, everybody, and welcome to today's wealthmanagement.com webinar, The Industry Landscape, What's Driving the Industry Movement, and Where Are Advisors Going? This webinar is sponsored by Tiff & Grow, so thank you to Tiff & Grow. My name is David Armstrong. I'm the Editor-in-Chief and Executive Director of Content for wealthmanagement.com, and I'll be your host today. And in a moment, I'm going to turn things over to the speakers, but first, just some housekeeping for how you can get the most out of this event. To improve your viewing and listening experience, you'll see a lot of windows inside your webinar portal there. You can move those windows around by dragging on the title bar. You can resize them by clicking on the right-hand corner, lower right-hand corner. And at the bottom of your screen there, you'll find multiple application widgets. Clicking on those icons allows you to open and close those widgets on your screen. You will not be taken out of the webinar if you do. Now, note that there is a link to download a copy of today's slides. It is available in the green resource list widget there at the bottom of the screen, so we recommend you download that and take a look at it. And please note that this webinar has been accepted for 1 CE credit hour towards the AEP designation program, and the Investments in Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, the CPWA, the CIMC, and the RMA certifications. And instructions for getting those credits are available in the resource list widget at the bottom of the screen. Again, instructions for getting those credits are available also in that resource list widget at the bottom of the screen. Note, too, that our speakers today welcome any and all questions about the topic, and they will answer as many as they can following the presentation, but feel free to submit yours to the queue at any time. The way you do that, just open up that Q&A widget on your screen, type in your question, hit submit, and we will collect as many as we can in the queue and get to as many as we can following the presentation. But again, feel free to submit yours at any time. Please note that today's session is being recorded, and it will be available for on-demand viewing following the event today. With that, I want to introduce you to today's speakers. Louis Diamond. Louis is the president of Diamond Consultants. In this role, Louis has guided many of the top teams in the industry as they've transitioned to another employee model firm or launched their own RIA firms. And Mindy Diamond. Mindy, of course, is the CEO of Diamond Consultants. Mindy started Diamond Consultants in 1998. Considered by the industry as one of the top thought leaders in the industry, regularly quoted by national media outlets like the Wall Street Journal, the New York Times, CNBC, as well, I might add, as a monthly columnist for wealthmanagement.com and Wealth Management Magazine. Both are also hosts of the syndicated podcast, Mindy Diamond on Independence. Highly informative. I recommend you check it out. You can find out more information about both of the speakers by clicking on the bio widget at the bottom of the screen. But with that, I'm going to kick things over to Mindy, who's going to tee up the topic for today.
David, thank you. And so I am Mindy Diamond, and I am absolutely thrilled to be here. Especially, we know the market's a little sideways these days, and we appreciate your time and attention. Hopefully, you'll find it worthwhile. So what I'd like to do is just sort of give some context to why we're talking today about what the industry landscape looks like. And I think the first thing to note is that there has been an enormous metamorphosis to the industry landscape in the last 10 years, a real evolution, if you will. And what that evolution looks like is a greatly expanded waterfall of possibilities. So that what used to be a binary choice, meaning if you were an advisor that was practicing at Merrill Lynch, the choice was either you'd go to Morgan Stanley or UBS or Wells Fargo, maybe occasionally a regional firm like a Raymond James, or you'd stay put and that was it. If you were an advisor that was independent with an independent broker-dealer, you might switch independent broker-dealers. Sometimes the really entrepreneurial of the like would go the RIA space, but not a whole lot. But today, because of the real expansion, legitimate expansion of the waterfall of possibilities, the choices are no longer binary. They're really infinite. And the infinite choices are good for the advisor, for the client, and for the advisor's team. Why? Because it means that the advisor is much more likely to find his or her version of utopia. And utopia is usually rooted in where is the best place or best model or best way for me to serve clients. So what I'm saying is the advisors are more likely today to find perfection or close to it. And what we find today is that the industry breaks into categories. There is a whole category of supported independence, which we will talk about to support the breakaway advisor, a whole category of new boutique firms, which we will talk about, certainly the regionals, which have really reinvented themselves, and of course the wirehouses and the independent broker-dealers. And we will get into all of it and answer your questions as well. And the only other thing I think worth mentioning is that it is a really strong seller's market right now. So no matter how much revenue you produce, how much in assets you manage, or what model in the industry, whether it be independent or traditional space that you practice in, the deals, the economics, the transition packages being offered are really at high watermarks. The only caveat is you need to be a quality advisor with a relatively clean compliance record. But as long as you have a portable book of business, it's a great time to be advisor.
That's great. Mindy, you talked a lot about the variety of options that are available to advisors now and the economics, which seem to make it a good time to move. But beyond that, what is driving advisor movement? What's driving the transitions that you're seeing right now?
Yeah, so there's been more movement in the last couple of years than we've seen probably in the whole decade prior. And what's driving it is what we call a combination of pushes and pulls. The pushes are the things that are frustrating advisors. And that is most typically too much bureaucracy, feeling like they're not getting enough value relative to what they pay for, no matter what model they sit in, whether it be feeling of loss of control or wanting more control or freedom, or generally just wanting to be something or create the business or craft the business to be something that they can't where they are. And the pull is the excitement and the enthusiasm of looking out at this landscape that's expanded and finding a much more robust opportunity set and a greater likelihood of finding something closer or more akin to what the advisor's vision is. And I think, as the next, and what we'll talk about, we're going to show you a graphic of what the industry landscape looks like. We like to think about it in terms of buckets. And then we'll break down each category so advisors can get a good sense of what it is.
That's great.
Okay, so I'm going to turn it over to Louis, who will walk us through this next slide.
Perfect. Thank you for handing off the baton. Hello, everyone. Louis Diamond, Mindy's son and partner. This is a very important topic. We like to think that this slide here is the ecosystem that we work in. We know this graphic might seem a little bit simplistic to some. Maybe some folks who work for specific firms on this webinar might say, well, I might fit into multiple buckets, which is probably true. We find it's often easier to think in terms of these buckets. And the thinking is the better you can understand the different categories, it's easier to then dive deeper into specific firms. So for instance, instead of trying to understand 10 different firms, Raymond James, Stifel, Ameriprise, LPL, et cetera, if you first understand what types of firms those are, it becomes a little bit easier to compare and contrast. So looking at this landscape graphic, we'll double click into each category as we move forward. But at a high level, the spectrum of freedom, flexibility, and control, all the way to the left is the most restrictive. All the way to the right is as independent as you can be. That would be a fee-only RIA, a real do-it-yourselfer. And then net payout too tends to follow a similar logic. The more restrictive typically means more support, more scaffolding, more resources, and then all the way to the right with more flexibility and control means a higher payout, but oftentimes it means more responsibilities. There's a trade-off between them. So let's dive into each individual category. So the first one that's worth mentioning is the bank brokerage model. So examples would be sitting in a bank branch for Wells Fargo or WBS, sitting in a Chase branch, or being a financial representative at Schwab or Fidelity. Obviously, many, many other banks. Point of this is, again, trying to understand the model. And usually with bank programs, there's a built-in referral source. So oftentimes a really strong way for an advisor to begin their career, get some warm leads, or it could be good for someone who just likes being an advisor, but isn't one who wants to get their hands dirty with business development. The downside is bank clients are bank clients, and portability is a big question mark. Usually a business leaving one of these programs, we're lucky if we see 25% of the business move. Sometimes it's more, sometimes it's less. Usually with referrals, it also means lower payouts. It could also mean a salary and bonus compensation model, which may or may not be what an advisor wants. And on the competitive recruitment side, these firms, with few exceptions, they don't typically hire experienced advisors with portable books of business. They may hire someone with 10, 15, 20, 30 million in assets, but you wouldn't necessarily expect a very lucrative recruiting deal, although that is beginning to change with this wholesalers market. And one of the potential critiques of a bank brokerage platform is it's a little bit more restrictive. There's less bells and whistles to support higher net worth individuals. Things like alternative investments might be more limited, probably a more limited solution on the investment side altogether. And again, a broad brush to use, but oftentimes it's a lower end or more retail client base. So let's go on to the next one. I'll pass it over to you, Mindy.
Yeah, so private banks are probably amongst the most restrictive in terms of category. And they tend to attract a pretty sophisticated advisor. And those advisors, we call them private bankers. And they are either generally relationship managers, where they're business developers and relationship nurturers, or investors, where they're responsible for investment management. Private banks like to hire teams. They like to have multiple touch points for each client because it makes the assets much stickier to the bank, right? The more people that are responsible for me as a client, the less likely I am to be tied to any one member of that team. And as far as the bank is concerned, it makes the business less portable, which is a good thing. Examples of this category would be private banks like JP Morgan Private Bank, Bank of America Private Bank, which used to be known as, or is sometimes known as U.S. Trust. You've got Bank of New York Mellon Private Bank and many others as well. So these are brands that have cachet. They typically cater to the ultra wealthy. Noting salary and bonus. So what's interesting to us is that there are a lot of people that find the private banking model to be an awesome way to start their business because, one, they are very much tied to the bank. So it's a great way to build a business because they're getting referrals from the bank. But private banks do not pay recruiting deals to recruit. And they don't pay on any sort of commission basis. For the most part, they're almost entirely salary bonus. Salary bonus can be a great thing for somebody that isn't willing to take a risk, that doesn't really trust the growth of the business. But for most advisors, they get to a certain place in their career where they trust their growth and they feel that a salary bonus model really caps them. So we talk regularly with private bankers that are generating, could be 10 or $20 million in revenue, and the banker is actually making a mere fraction of that. So most private bankers, or many private bankers, I should say, ultimately outgrow the model. They outgrow it not just because of the compensation model, but because oftentimes they're limited in terms of the investment solutions. There's no concept of open architecture. And when these advisors, if these private bankers go to move, they are really restricted. Most of them, their employment agreements have very onerous post-employment restrictions in them, which means a garden leave, which often means a non-solicit, sometimes a non-compete. For those unfamiliar, what a garden leave means, which is the most restrictive of all post-employment restrictions, is that the advisor leaves or the banker leaves, but can't contact clients for at least 60 or 90 days. So imagine making a move and having to literally be in a blackout period from connecting with clients for 60 to 90 days afterwards. So it's the riskiest of moves to make as well. And the only other thing I'll say right now is what's interesting is Lewis and I actually just wrote an article that was published very recently about private bankers. The industry as a whole has typically been pretty fickle about recruiting private bankers, worried either because of the garden leave, that the business was less portable, or because generally the assets tend to be more tied to the bank than oftentimes to the advisor. But because of this strong sellers market and more competition for top advisors, the firms, all firms of all shapes and sizes, are interested now in private bankers. And one of the places we are finding private bankers moving to is the independent space. Lewis and I, as David mentioned, we do a weekly podcast called Mindy Diamond on Independence. And one of the trends we're seeing are private bankers moving toward the independent space. So much more to come on that as well. So let me turn it over to you, Lewis, to talk about the next category.
Perfect. And one other thing to add on private banks, similar to the bank brokerage model, just a good tip for anyone who might be considering leaving a private bank. It behooves you to be very realistic and even conservative about your asset portability. If you, let's say you manage $2 billion in assets, no one's necessarily going to believe that you're going to move $2 billion. Usually, again, it's about that 25% number. So it makes sense. You build credibility with potential firms. You also set yourself up to be in a better business planning mode if you're realistic about what's portable. So I'll take this one, talking about wirehouses. So wirehouses, no surprise, are the biggest firms on the street. They're I think 3 of the 4 largest firms, W-2 firms, are the wires. Morgan Stanley is the largest, close to 18,000 advisors these days. UBS is more of the boutique of the bunch at about 5,000 advisors. Merrill is about 12 to 13,000. And Wells Fargo advisors across their various channels, which we'll hit on, is, I think, close to 15,000 as well. So what these firms all have in common is the brand. They're recognizable brands, for better or for worse. No one's going to question who the firms are, which gives advisors comfort that they have the stability and the reputation of their firm behind them. What advisors like to, and what clients I think do as well, is that everything can be found under one roof, meaning it's the investment platform, all the alternatives, discretionary, non-discretionary portfolios, brokerage business, but then you also have a critical element, which is banking and lending. All of the firms either are banks that own a wealth management firm or are banks that have wealth management capabilities. There's somewhat of a distinction there. So advisors like that they can service an advisor on both, they can service a client on both sides of the balance sheet and have it really be one-stop shopping. And oftentimes that framework is a benefit when an advisor looks to leave and they look to have even more open architecture. But sometimes it's a nice safety blanket for advisors. So in the seller's market, everyone gets to pick what's most important to them. And that's an element that some like and some don't. Wirehouses too, for people have negative things to say about wirehouses often, and oftentimes the cultural fit with wirehouse teams, certainly in independence, is not very strong. But the one thing that's undisputed is wirehouse advisors grow, and they're the most productive advisors in the industry. For the most part, all 4 of these firms, the average advisor is doing well over $1 million in production. They tend to form teams as well, and organic growth rates tend to be better than the industry average. And you could say it's because their compensation definitely favors bringing in new households, but I think it's also just the wirehouses take a lot off an advisor's plate. On the negative side, though, the wirehouses are known to be much more heavy-handed with compliance and bureaucracy. A lot of layers of management. Creativity is not something that's rewarded. It's oftentimes struck down. And many of the firms have a culture of saying no, which some folks look to get away from. But at the same time, a wirehouse is a really, really attractive place for many advisors for their whole careers. And there are differences between being an advisor at Morgan Stanley versus being an advisor at Merrill and UBS, et cetera. And then last thing I'll mention on recruitment deals, wirehouse deals tend to be some of the most aggressive. $1 million plus team can likely see a deal in excess of 300% of their trailing 12. Part of it up front, part of it on the back end, and unvested deferred compensation is oftentimes fully replaced or is partly replaced. The one exception is Bank of America Merrill Lynch is not really recruiting these days. So that is a potential consideration.
Yeah, and go ahead, David. I'm sorry. I just want to add one more thing there, too. Go ahead.
Go ahead, please.
What I was going to say is with respect to Merrill, so Merrill's strategy lately is about recruiting advisors that can really take advantage of sort of all of Merrill Lynch. The notion of hiring somebody that's more akin to a private banker. And and they're looking to bring a lot of these folks in more of a salary bonus construct. So in terms of competitive recruiting, it's probably more in terms of the wirehouses, more Morgan, UBS, and Wells Fargo. David, I'm sorry, I interrupted you.
No, I was just going to ask, one of the things that Lou mentioned was the attraction inside the wirehouse for the fact that you get a lot more stuff to do with your clients, right? Securities-based lending, maybe some kind of proprietary investments that aren't available elsewhere. Is that true in the private banks as well? I mean, are those kinds of things becoming less of a competitive advantage for the wirehouse?
Are you asking me or Lewis?
Well, I guess I was asking Lewis, but I'll ask you as well. Either one.
Go ahead,
I think Lewis. Yeah, I think Lewis actually had some audio problems there. We got a few. Yeah. I didn't hear it, but we got a few comments about some audio problems. It sounded okay to me, but maybe he's taken himself offline to try to fix that. Go ahead.
Okay,
Mindy.
so I can answer that question. So the answer is that in today's day and age, it really doesn't matter whether you sit at a wirehouse, a private bank, or fully independent. Platform and access to what you need is pretty commoditized. That's part of what makes this expanded landscape so cool, so interesting for advisors, because even if you choose to go from a name brand like Morgan Stanley to build your own firm, Mindy Diamond Independent Wealth Management Firm, I don't have to sacrifice anything in terms of products and services or technology. In fact, what's probably more true today than ever is that the bigger the firm you're at, the less likely you are to have the ability to shop the street and create competition for price and service and get open architecture. So as we move more toward the right end of the spectrum, we'll talk about what that means.
And could you guys also just mention one more thing about the protocol around the wirehouses? We heard about this broker protocol. I think some brokers are falling away from it, some are still in. Explain to me how that's affecting the landscape.
Yeah. Well, I don't know if Lewis is back, so I will answer. So several years ago, Morgan Stanley and UBS notably decided to take themselves out of the protocol for broker recruiting. So to back further up, the protocol for broker recruiting was a construct that came online probably a little less than 2 decades ago, where the big firms got together and said, let's get together and sort of have, a truce, if you will, that if you recruit mine and we recruit yours, we won't go after the advisors as long as they adhere to a certain set of pre-agreed steps. And those steps are essentially not taking original account documentation. They are, taking a pre-agreed or predetermined or pre-allowed 6 or 7 set of items. And as long as the advisor doesn't violate the steps in the protocol, we'd be happy to send you a copy of what's involved in it. The advisor could move freely between firm without fear of any sort of legal hassle. But a couple of years ago, Morgan and UBS said, we're losing a lot of advisors. Let's take ourselves out of the protocol. It hasn't in any way impacted their ability to recruit, but it does mean that any advisor moving to or from Morgan or UBS is going to fall under a non-protocol move, because in order to get protocol protection, the buyer and seller, or the recruiting firm and the leaving firm, both need to be part of protocol. And so we can talk if anybody's got questions either offline or later about, so how does that change a move? How does that change what you do? But it is a little bit different, but very doable. Hope that answered your question.
Yeah, I think so.
Good.
All right, I'm doing a quick test if I'm back in the party.
You sound good.
Perfect.
Sound good.
You're
Sorry
back.
about that, everyone.
No, that's okay. All right. Well, so I was going to take the regional firms, if you don't mind. So the regional firms are probably, or let me give you an example, first of all. They're firms like Raymond James and RBC and Ameriprise and Janney and Stifel. These are the firms that have probably experienced, as traditional firms, the greatest amount of metamorphosis or change. We joke that the regional firms are not your father's or your grandfather's old regional firm. Regional firms had historically been also rans. They were also ran in terms of the caliber and quality of leadership. You know, the branch managers were sort of a step below what they were in the wirehouse world. Technology was a step or 5 steps below. Platform was sometimes lacking. And even in terms of advisor production, average production, it was much lower than at the wirehouses or even the independent space. But in the last 5 to 7 years, the regional firms realized a couple of things. One, that they had an enormous opportunity to recruit and capture the attention and love of all of these advisors that were feeling not loved enough, or a lack of control, or too much bureaucracy at the wirehouses, and they wanted what the regionals have. So today, the regionals have reinvented themselves with spectacular technology, with excellent, outstanding leadership, with great platform, and really a culture that offers much more autonomy and freedom and control, and really kind of feels like the absolute perfect middle ground between being fully independent and working for a big bureaucratic firm like a wirehouse. They are firms that really focus on culture and advisor-first mentality. In fact, Raymond James, for example, is the one firm, one traditional firm on the street that actually writes into the contract of a W-2 advisor that they own their book of business. And that can be should be incredibly appealing to an advisor. What I mean by that is that if you leave a firm like Merrill Lynch, it means that the advisors left behind at Merrill are free to go after your business. At Raymond James, if you were to leave Raymond James, nobody is attacking your book of business. You own that business. So today, stronger platforms, better technology, and it should say no less so than the wirehouses. Transition deals can sometimes be a bit less. It depends. They're all over the map. So while Lewis made the comment that all wirehouse firms are probably paying deals in the 3x range, regional firms probably pay deals, depending upon the firm, anywhere between probably 125% of trailing 12 all in to as close to 300% all in. So it really depends upon the firm. And many of them, like Raymond James and Ameriprise, have multiple ways to associate. And we'll talk about the more independent options for those firms as we move through the spectrum.
Yep. The only thing I'll add on the regionals, sorry, David, is a somewhat common, I guess, flow of events that we see, especially with wirehouse teams. They start off wanting independence. They think that I'm so frustrated with the bureaucracy at UBS or at Merrill, fill in the blank of the firm, and the only way to really remedy that is to be independent. But as they begin to look at options for whether it's economics or the amount of work, or just realize they're not that independent, they oftentimes double back to a regional, and it provides just the right amount of freedom and control, and still gives them the support and structure that they've come to like. So it's more common than uncommon that happens. So I bring that up because that's one of the really exciting things about this landscape. Is, like Mindy said in her opening, it's not binary. Advisors can be very successful really in any bucket of the industry, because there's been so much development and competition to bring along platforms and technology, which is somewhat of a commodity these days. And many of these regional firms have really leaned into advisor choice and putting advisors in the driver's seat.
Do you guys think that there is a place for advisors who focus on the ultra high net worth at the regionals? I think there's been a perception that that's not the case. I don't know if that has changed as well.
Yeah, I'll take that one. Oh, go ahead, Mindy.
Okay, Liz. Sorry, no, go for it.
Okay, so I would agree, David. That is one of the knocks on the regionals. It's somewhat true, but it really depends upon the style of business an advisor's doing. So the regionals tend to be more conservative than their wirehouse counterparts. So alternatives tend to be a little bit more curated and not as robust. Lending, they all either own banks or have access to it, but they're obviously not the banking powerhouses like Wells Fargo or Bank of America. So depending upon the type of lending someone needs, it might be not as strong. And then probably the biggest one is the brand perception. That's probably more so on the advisor side than client, but advisors hold some of the wirehouse brands in different regards as they do the regionals. Although I think that's rapidly changing.
Yeah, and I would add one thing to that. I absolutely agree that if you service ultra high net worth clients, meaning the whole of your book is servicing ultra high net worth clients, I'm not sure the regionals are necessarily going to be your first choice. But one of the changes we've seen recently is many mega teams, $5 and $7 and $9 million teams, choosing to go to Raymond James and RBC and Ameriprise and Janney. One, because they like the culture, they want more control, and two, because they want the option for their next generation to be able to slide into independence at some point, and it's a lot easier to do that from a regional firm platform. Okay, so let me talk about the boutique firms. So boutique firms is, while I said the regional firms have probably experienced the greatest metamorphosis, boutique firms have changed completely, and I'll tell you what I mean by that. A decade ago, when we mentioned boutique firms, we were talking about firms like Credit Suisse and Deutsche Bank and Barclays. But all of those firms went away, as we know, for one reason or another in the financial crisis. What they've been replaced with is what we call the new boutiques, or boutiques 2.0. And that's more firms like JP Morgan Advisors, which is the old Bear Stearns unit acquired by JP Morgan. It is very much First Republic and Rockefeller. The latter two firms really, really aggressively recruiting and capturing advisors who do service high net worth clients, who look at independence and feel that independence is a bridge too far. They look at independence. We've had so many of them who came to us saying, I want to be independent because I want to build equity, because I've got a kid coming into the business and I want to build a legacy and I want to be able to sell my business and I want to, brand myself. But as they begin to look under the hood of what it takes to be independent, many of them find it a bridge too far. Most notably, there's much less transition money, so much less ability to de-risk in the short term when going independent. These boutique firms feel like the best of both worlds for that advisor. They're built on RIA, First Republic and Rockefeller anyway, are built on RIA chassis, so they feel independent, custodying third party with the likes of Schwab and Fidelity. They have an elite advisor force. They pay very, very aggressive transition packages, and they absolutely give advisors more control and freedom than they have with a W-2 model in a traditional firm. The only negative about them is they're highly selective, and they're really only in very select markets with limited appetite to open in markets where they are not. So if you're in Albuquerque, New Mexico, you're much less likely to see JP Morgan Advisors, First Republic, or Rockefeller being there. Anything you'd add to that, Lois?
I think that the one thing is it's really the focus on the ultra wealthy. So it's kind of the best of the private banking world, but without being in a salary bonus model. So depending upon the firm, alternatives are going to be a big strength. Lending, certainly with JP Morgan and First Republic, are very strong there. So it's platforms that advisors serving more affluent clients really gravitate towards. That can work both ways, though. We've worked with plenty of high net worth focused teams who have a more plain vanilla business. They don't do much lending. They don't do much alternatives. And for them, they'd rather go to a firm that is allocating resources in the areas that they care about most. Because no firm is going to be perfect, for all the great things all these firms have for the ultra wealthy, there may be some areas, whether it's technology or scale, that may be lacking compared to some of the competitors. So it's all about perception. Again, no perfect fit anywhere.
Right. And we didn't mention deals. You want to talk about that for a second, Louis?
Sure. With these firms, if it's a team that they're going to go after, which likely means multi-million-dollar groups with a select number of clients, these three firms in particular likely aren't going to lose on deal. They'll compete with the wirehouses head-on, probably even be better in many cases. And because of the size of the firms, they tend to customize the structure a little bit more to what a team is looking for. So very, very attractive, but still a W-2 model. So ongoing payouts would be similar to a wire or regional, around 50%, give or take, for a larger team. So not independent, but has some of the attributes of independence that some people will look for.
Great.
Got it. Louis, I think you're going to tell us a little bit now about the quasi-independent firms.
Yeah, perfect. So these firms, I don't really like the name quasi-independent. We'll have to come up with a new moniker for next time. But they're W-2 firms, but have many elements of independence. So kind of picking up where the boutiques left off with feeling independent, these really take it a step further. So these firms, they either offer an advisor to run their own P&L. So that would be like Raymond James Advisor Select, which is still W-2 under Raymond James and Associates, but they give larger teams a higher payout, still W-2, and let them choose how to invest in their business, which likely means a higher net payout. It's companies like Stewart Partners that will offer cash and also offer stock in the business and still own your underlying practice. And then LPL launched a new W-2 option, kind of independence, but in a W-2 wrapper where advisors own their book. So these models, it blends many elements of independence, which is ownership and control over cost, but still give advisors employee benefits, 401k plans, sitting in firm-owned real estate. So really good for advisors that either feel like they don't have the scale to go independent on their own, who looked at independence and it's a bridge too far, or for those who just, they like many elements of a W-2. They like the comfort of it, and they want to still have more autonomy. So being able to have their own self-brand or have a more unique brand under a larger brand. I think we're going to see more of these quasi-independent firms pop up because they've become very popular. And quite honestly, I think there's a lack of them. And I think there's some other firms, more so in the RIA channel, that are going to continue to kind of morph into this world and try to meet advisors where they are. And where advisors are is most advisors want more freedom and control, but they're looking for support. And that'll be the theme of a lot of the rest of this presentation. Perfect. Okay, so I'll take the next one. So the next, really the rest of our landscape slides here, they're all going to be options that an advisor is independent. Probably more similarities than differences between independent broker dealers, the next slide, which is RIAs, and then what we call supported independence. The common themes amongst all of them is the advisor owns their business, they own their data, they own the client relationship, and they control their own expenses. They're business owners. In an independent broker dealer, largest one by a decent margin is LPL Financial. You also have the independent arm of Raymond James, the independent side of Wells Fargo Finet, Commonwealth, the independent arm of Ameriprise, the independent side of Stifel now, and hundreds of more. Cambridge would be another one that's popular. So with these businesses, an advisor is a 1099 independent contractor. They hang their securities license with the broker dealer. They do their advisory business through the firm's RIA. They self-brand, oftentimes can use social media with much less restrictions than in a captive model, but still somewhat of a governor on what they can do. One of the negatives is an advisor is captive to that firm's platform and their tech stack, meaning if I'm at XYZ broker dealer and there is a private real estate deal that I want to do, if it's not on the platform, it's going to be pretty hard to do it because these firms handle compliance either through and through, or they have internal OSJs or solutions to handle compliance. So an advisor is going to be captive to what's available on the platform, not so dissimilar from being at a wirehouse or a regional where it's more curated and you can't really go off platform. Same thing with technology. Many of the independent firms have really came a long way with a really strong integrated technology stack, but it's what you see is what you get. So on the one hand, you don't have to go through the customization of picking a CRM system and a performance reporting tool and a planning software, but what the firm has is what you're going to use. So it takes away some options, but also takes away optionality. So that's either a good thing or a bad thing, depending upon an advisor's perspective. Independent broker-dealers also, they do pay recruitment deals. They're structured as forgivable loans or forgivable notes, usually between 5 and 9 years. Some go up to 10 years. And it really ranges depending upon the broker-dealer and the practice, but it could be anywhere from 25 to 30% of an advisor's trailing 12 or their GDC. Some of the broker-dealers will pay in excess of 100%. So it really depends. And payout-wise, They tend to be payouts high 80s, low 90s, but then you also have to take into account platform fees, admin fees, ticket charges, E&O insurance. So the true net is much lower than the advertised grid rate. So an advisor likely lands net before local costs, probably somewhere in the low to mid 80s, or maybe lower if it's a smaller practice. But a lot of really good options, and many wirehouse teams or captive teams look at these models as a way of gaining independence, but with much less heavy lifting than the RIA model. And like you see, some of these names are familiar from previous slides: Raymond James, Ameriprise, Wells Fargo, Stifel, et cetera. A very popular move is for advisors to start off as W-2s on those platforms. Those would be in the regional or the wirehouse bucket. And then as their needs evolve, move over to the independent side of the house without repapering. So that's the independent broker-dealers. And I'll pause there.
Good. One of the things that struck me, you mentioned it a little bit here, you alluded to it a little bit there, that advisors are becoming more fee-based, right? They're starting to look more like RIAs. How are these firms, the independent broker-dealer channel, accommodating them, or how are they transitioning or transforming to help those advisors?
Yeah, exactly. So it's a really good question. So first off, I would say that the leaders of most of these platforms, especially the scaled players in the space, they're definitely not deaf to the concept that advisors are becoming more advisory focused, which could be a threat on their business model, but I don't think it really is. It's just an evolution of what a broker-dealer means. So many of these broker-dealers, take Commonwealth for an example, they'll position themselves as really an RIA that owns a broker-dealer. Or many of these firms now will allow a registered representative to drop their Series 7's license, still stay on the platform, and just become an IAR only. So it gives the advisor some of that RIA feel. They can market themselves as a fiduciary. And then some of these broker-dealers, too, have RIA custodians or have services to support advisors that want to launch an RIA. So really, I think the future of an independent broker-dealer is more of a technology and service provider to RIAs or to advisory-focused businesses. There's still going to be a place for independent broker-dealers for sure, but the good ones are changing to meet the needs of the industry. And that's a consistent theme, is change, but it's how firms adapt to that change that determines who's going to be the winners of today and tomorrow.
Yeah.
Yeah. Go ahead, Mindy. Sorry.
No, I was going to say, so that brings us to sort of the last category, or almost the last category on the continuum, which is the RIA space. And it is the space where, and when I'm referring RIA, there are certainly fee-only RIAs, but the vast majority are hybrid RIAs that do a combination of both commission-based and fee-based business. It is the model that requires the heaviest lift when going from being a traditional employee advisor to being an RIA. The good news is, and Lewis will talk about it in just a minute, this whole ecosystem born to support the breakaway advisor means that advisors today are much more likely to find the support that they need to get there. The benefits of the RIA space are essentially the maximum in open architecture. The RIA space is all about the opportunity for the advisor to shop the street and create competition for price and service for everything and anything, from lending to structured products to alternatives to insurance to trust capabilities to investment banks, whatever it may be. And all of that inures to the benefit of the clients because they're creating competition for price and service. The other thing is that an RIA is probably the most valuable on the open market. So advisors that run big businesses love the idea of being an RIA because there is the M&A market right now for RIAs, for well-run RIAs, about as frothy as it's ever been. And a well-run, scaled RIA is selling for multiples bigger and better than we've ever seen, and no shortage of buyers. Those buyers ranging from larger RIAs to banks. I mean, First Republic years ago bought Luminous Capital, which was an RIA where the principals had started at Merrill Lynch. You've got private equity firms into the space. You've got family offices looking to invest. You've got clients looking to invest in RIAs. So it's a really interesting space, but it is the heaviest lift. And oftentimes doesn't really pay any upfront capital. So it's also the one that requires the greatest risk upfront. But I'm going to turn it to Lewis, I think, to talk a little bit about the category of supported independence, because it rounds it out, if you will.
Mm-hmm.
Perfect. Yeah. So the supported independence, this on our continuum, we put it last because the supported independence, I would say, can go over the independent broker-dealer category and the RIA space as well. This is where we're seeing the most expansion of new and exciting models. There are firms that saw a hole in the ecosystem for independent advisors and said, there's something that isn't out there that's blocking either advisors that work for me or advisors that I know or me as an advisor from going independent. Let's figure out a way to help advisors get over the finish line. So what these platforms typically do is it's turnkey assistance to launch the business. So help with procuring real estate and building it out, negotiating a lease, ordering furniture and painting the walls, and coming up with a logo and social media and a website and procuring employee benefits and et cetera, et cetera, et cetera. The hundreds and hundreds of things that have to happen for an RIA to be launched or an independent to be launched. These firms help in a very turnkey way. We think this has been one of the major catalysts for the breakaway movement. If you look at companies like Dynasty Financial Partners, who's probably one of the best well-known supported independence platforms, they really created this category, created by Cheryl Penny 10 plus years ago, and many others have came on the scene, picking up where Dynasty left off, or not even that, but offering a bit of a twist on Dynasty's version of supported independence. So these supported platforms, they could be under a broker-dealer, like LPL, Long Strategic Wealth Services, which would be this supported model. There's Sanctuary Wealth Partners, which would be in the RIA space. Dynasty's in the RIA space. And there's probably 15 to 20 others that I apologize, I'm not giving a shout out to, that do something similar, which is advisors that want to be independent. They don't want to be alone. They want help with starting the business. And then they also want help with running it on a day-to-day basis. So advisors want to be CEOs. They oftentimes want to be the CIO, but I haven't met an advisor that's really excited about being a chief compliance officer or being a chief operating officer. So there's solves for this in a bundled solution, which is supported independence. And this is also how some advisors that want independence can access upfront capital.
Ooh, that's great. I had a couple of quick questions there. When you talk about some of the dynasties of the world or the sanctuaries of the world, how does that compare to, I think, what a lot of advisors here now are the aggregators of the world, right? Like your CI Financials, your Focus Financials. Where does that kind of line of support versus ownership versus investment, where does that fit?
That's such a good question. So the aggregators, the ones you mentioned and many others, they're buying the whole business or they're buying a piece of the business. With these models, unless you want to, you own 100% of your own equity. So a firm that launches with Dynasty or Sanctuary or LPL, they may be the acquisition target of 10 years from now for CI Financial or Beacon Point or Focus or Hightower. So that's really the big distinction is ownership of equity and cash flow.
Do these supported independence firms, we see the value for the transition for the advisor, but what sorts of services do they provide on an ongoing basis after that?
Yeah, so I would say that's the, yeah, exactly. So the supported platforms, they definitely charge a premium for their services. Of course, they're running a business and providing a service. Advisors find immense value in what these firms do to launch the business, and certainly in the beginning. Where there's sometimes friction with these models is what sort of support is the independent advisor going to draw from that platform on a go-forward basis. So some advisors are delegators, and they want to hand off activities like finance, like client billing, like compliance, like operations, investment operations, et cetera, and want to have a network of like-minded advisors. Others, they like the support. It kind of gets them to where they want to be as far as running an independent business, but it's just harder because these advisors are now independent for the platforms to keep adding the same amount of value. So they keep evolving and adding services like mergers and acquisition support or offering to take minority stakes in companies, technology innovations, et cetera. But I would say that there would probably be one of the downsides that someone would find of supported independence, is that you're paying a premium, certainly relative to starting your own RIA. But there's still a lot of value that all these firms add.
Fantastic. That brings us to the end of the presentation, end of the landscape, and moving into some questions. And I want to remind the audience that both Luis and Mindy will take any questions you have. Just pop them into the Q&A chat there, and we'll get to as many as we can in a moment. I'll just kick it off, though, real quick. I guess Luis, I'll ask you this. You went through all the models. Any idea which of these models have changed the most and why?
Yeah,
Where have you seen the biggest evolution?
I think it's that supported independence category. Most new firms or models that pop up, they're not launching broker-dealers. They're not launching the next wirehouse, although I guess Rockefeller was trying to take a stab at that to an extent. The new platforms are providing this supported version of independence and trying to pick up where they thought others have fallen short. So that's probably where we're seeing the most new options. It's also what's changing the most. As we talked about the blurring of the lines between broker-dealer and RIA, where they're blending is the services that the firms are providing. So very succinctly, I would say supported independence is what's changing the most, and certainly where I think we expect there to be even more disruption going forward.
And Mindy, then I guess to you, is that where most of the advisors are going, and is that why, or where do you see most of the advisors transitioning to amongst these models?
Yeah, well, I think, in the olden days, every year there was a winner, the hot model that everybody went to. That is absolutely not true anymore. There are sort of phases that the industry goes through, but where advisors are going is really pretty fractured. And what just determines where they go is really how entrepreneurial the advisor wants to be and what the advisor is looking to solve for. That, again, is what makes it all so exciting right now and why there's so much movement, because there's more choices than ever before. Advisors are more likely to find their version of utopia. And so, for example, the independent, the breakaway movement, the notion of advisors leaving the traditional space and going independent has been really hot and really valid for a really long time now, at least a decade. But it's becoming even more valid over time because more of these supported independent models are popping up. You've got firms like Rockefeller and First Republic that are equally crushing it because, again, they sort of cross the chasm between the two. So it depends upon what the advisor wants, but no real one clear winner.
Not one channel.
One thing I'll add is I analyze our firm's placement data. So last year, we facilitated advisor movement in excess of $30 billion in assets under management. And across all of those advisors, it was interesting. We were about a third where advisors moved to. So about a third stayed within their channel. So Merrill went to Morgan, went to UBS, et cetera. A third went to a smaller, more boutique W-2 option. So that would be I'm at Raymond James W-2, I'm going to go to Stifel. So they opted for something more boutique or maybe a little bit smaller. Could also put Rockefeller or First Republic in that category. And then about a third either moved within the independent space. So they went from Cambridge to RIA, or they went from LPL to a different broker-dealer. So really, really fractured, just looking at our own placement data with where we're seeing advisors go. And I think we'll continue to see that. And I'm not expecting those numbers to change all that much. I think there's a flavor of something out there for everyone. Just matters what it is you want.
I think there's some interesting questions coming in from the audience, and I want to jump on some of them, so I'd love to hear your thoughts. Someone here is asking your thoughts about margin compression across the various models. That kind of feeds into something else we were talking about what models are providing the best deals, what models are giving the most support. What are your thoughts about margin compression? Are you seeing it more in some channels or across the board?
Yeah, I could take a stab at that. So I think I understand the question to mean, I'll take it as with margin compression for at the advisor level. I guess you can take it from two different perspectives. But from the advisor level, how are the various platforms helping advisors overcome margin compression. I think one of the ways is by these firms at scale can provide shared services at a way that is much cheaper and more efficient than an advisor can do on their own. So we're seeing some firms add a paraplanning function where advisors can hire a paraplanner on an hourly basis instead of having to hire a CFP on their team. We're seeing some firms really enhance their alternative investments platform to make advisors access, I guess, a door opener and something exclusive rather than being more of a commodity. And one other example would be many RIAs and platforms are providing or democratizing the multifamily office model. So in-house for a non-$10 million plus client are offering things like tax preparation and bill pay and estate planning. So I think it's the platforms itself are going to help advisors solve the margin compression problem.
Interesting. Someone here is asking, how have the custodial firms caught up in providing that supported independence technology and operations back office support? I talked about the RIAs, and we were going to talk a little bit about the importance of being multi-custodial, but can you speak a little bit about how the custodial platforms have stepped into the role of being essentially RIA support platforms?
Yeah, Lewis, I'll let you take that as well.
Okay, on it. Yeah, so the custodians are, they're pretty incredible with their consulting services to help advisors launch a business. There is, though, somewhat of a limitation on how far a custodian's transition support team is going to support an advisor in their transition. So a good example is the technology consulting team from Schwab. They're very smart. They have a lot of resources. They'll help with saying, here are the 6 preferred performance reporting systems that integrate with our platform. Here's a contact for Joe at Adipar, Philip at Orion, Benny at Black Diamond, et cetera, and good luck. And let us know if you have questions. But they're not going to take it as far as negotiating contracts or really getting super in the weeds with how it works for the advisor's practice. That's an oversimplification, but that's kind of the way to think about it. So the custodians, because they're platforms, they're basically giving them away free to advisors, and you can trade for no cost on Schwab like you can Fidelity. The big way that they're trying to step up their value adds is to provide more support. But while the costs are what they are, where it's a third-party payer model, meaning the client paying for a custodian's services, at least for now, there's not nearly as much margin or interest on behalf of the custodian to get super in the weeds and provide the same supported platforms that a platform like a Dynasty or a Sanctuary might provide. I think that'll likely change, and maybe there'll be another evolution will be the supported platforms of the custodians. And we'll certainly be interested to see when Goldman is finally ready to go live, see what type of services they're going to provide differently than the major custodians today.
Interesting. Mindy, you mentioned earlier the volatility in the markets. Someone's asking here if you think that is going to slow down the pace of advisor movement, or how you think if we had a prolonged downturn in the markets, many people are predicting, what's the impact on the industry?
Yeah, so it's an interesting question, and I think it goes both ways. Look, if it's prolonged volatility, advisors are overwhelmed and busy and don't have a lot of time for due diligence. But generally speaking, times of volatility don't really have much of an impact at all on advisor movement. One, because just from a self-serving perspective, an advisor is trailing 12. The revenue upon which his deal will be based is maybe higher today than it might be 6 months or a year from now. So if they're thinking about moving, it's better to move based upon a higher revenue number than a lower. But beyond that, if an advisor is looking to move because they are looking to better their situation, to find a way to better serve clients, to better grow their business, to have a better quality of life overall. Those are things they're looking to solve for, absent and apart from what's going on in market conditions. And it is also the notion that if I am considering another firm, part of the reason I'm considering it is because I believe they are going to give me better tools and resources and platform and human capital and input to be able to weather a storm, volatile markets included. So I mean, we've got plenty of advisors that are in play, if you will. They may be busy the last couple of days and not so interested in talking with us, but none of them are thinking about not moving.
That's great. We are at the top of the hour. We have a lot more questions here. We didn't get to every question in the queue. These questions will go to Louis and Mindy, and if they are so inclined, they will reach out personally and answer each of you. But you guys, this has been great. We have run out of time. We're going to get the hook from the platform here in a minute. Thank you, Mindy.
Yeah.
Thank you, Louis Diamond. Thank you. Outstanding presentation.
You.
Great stuff. We also want to thank Tiff and Grow for sponsoring today's webinar. And once you leave this event, a short survey is going to pop up. We would love it if you would just tell us what you thought. It helps us provide you with information that's most useful for you in the future. So with that, on behalf of wealthmanagement.com, have a productive remainder of the day.
Thanks, everyone. Appreciate it, David.